My name's Nicola Crosbie. I'm a Chartered Financial Planner and owner of Moran Wealth Management.
Hello, I'm Richard Jones, Chartered Financial Advisor and previous winner of the Personal Finance Society's Investment Specialist of the Year.
I'm Alena Zavarin and I'm a Chartered Financial Planner working for Anderson Financial Management in Bristol.
So one of the questions we get asked a lot is now a good time to invest?
Well, my personal thoughts on that is every time is a good time to invest. I think if you're not investing and you've not bought into the concept, you should consider it, because there's never going to be the right time, is there? But it's better to invest than not invest.
It's never the right time for everyone, but it needs to be the right time for you. If it's right for you, you'll be fine. But trying to match everyone, I think it's just very hard.
Yeah, I think one of the difficulties that we see is that people try and time it and want to find the bottom of the market. And the difficulty is when markets fall, it's the least comfortable time and people then are most nervous about investing.
Yeah, I agree. This is a saying, isn't there? Time in, not timing the market. But I think you're never going to get exactly the right time. But if you've got a need and a want to invest, then you should start now, because if you delay it, then it could cause problems, couldn't it, in later life? In my experience, I see people getting a bit overconfident sometimes when they invest. Is this something you've come across, and do you understand why that happens?
I think that it's easy to understand, and I can feel that sometimes. If things are going really well for quite a long time, it can feel like you're running. You get this euphoria, you feel great, and then you start taking too much risk. So you come up on that, on that wave of emotion, and I think that's the time when you can just get really stuck into it, and that's when you can make some mistakes.
Yeah, I think you see it in other areas, not just finance, where people who, as you say, they're on a roll. If you're consistently winning and winning and winning, you get to feel that you're kind of untouchable, and that's just not how it works. And it's really easy to well, we call it confirmation bias, where you think something might happen, it does happen, therefore you think you suddenly know more than you actually do. It doesn't mean you know everything about the next thing.
So I've read some research once to say you might feel 9 times worse when the market falls than when it rises. So you automatically stop doing things, which actually it's better to do it when the market falls, isn't it? Because it's better value. But when things are going up to the top, you kind of go with the herd, don't you? Is it herd mentality, I think it's called? So you do what other people are doing, which is put money into the market and take investment decisions.
I think that's it. We hear success stories. No one shares on social media, just in the media everywhere. You hear success, you don't hear failure. So I think that's what makes people feel better about themselves and take more risks.
And it's happened with lots of different markets, hasn't it? You think of property, you think of cryptocurrency, all of those kind of things. People think that because it's gone well, it will keep going well. And because they've made some money, they'll keep making it. And the evidence is that that's just generally not what happens.
It's quite common in life to sort of go and do what you think other people are doing that's good, don't you, as well, and just get caught up in the emotion of that. But actually, you really need to start to work out what works for you and not works for other people, because you don't really understand their circumstances, do you?
So, simple question. How shall I react when my investments fall in value? What would you guys do?
The first thing to do is to remember why you made the investment. Presumably, it's a long-term investment objective. So if it's fallen today or this week or this month, is that the most important thing? The most important thing should be your long-term return, so you make sure it's still appropriate for that, I would say.
Yeah, I would say it's trying to stay calm in a very difficult situation, because it's so easy to be caught up in the emotion or the media press and think that everything is worse than it is. So a bit like what Richard said, if you've got a plan, you have to stick to it. If it's a good plan, it should be factored in, market volatility in the short term. So you should be comfortable with that.
It's almost taking a step back, isn't it? And trying to reconfirm that long-term perspective and see the end goal, see the starting point, and think, this is why I'm doing it. That's what I'm doing.
And with the point on the media, I think it's a really good one, because we sometimes hear on the lead story on the news is that billions were wiped off the face of Britain's largest companies. You never hear tens of millions added in boring days trading. But that is what happens way more often.
Yes.
But it just doesn't grab your attention or the media's attention in the same way.
Yeah. Personally, I think if you're working with someone like an advisor or an industry expert, you need to pick somebody who's calm and who's able to reassure you during these times of volatility, because that's their job. And if you work together personality-wise, they will add great value to you during that.
So one of the things we often get asked is, should I invest in the next big thing? How do you advise people on that?
It's so easy to get carried away. We hear things and we've got this herd mentality kicking in. Now it's a fear of missing out. Someone else is doing it, I should just get on it and not miss this. So it's just, I think, again, it's taking a step back and thinking, what is the reason for doing it? Is it right for me? Can I take on that risk? Will it work? And then kind of distancing yourself from that herd.
Yeah, personally, I don't think there's ever one next big thing. I think it's all about investing in different things and diversification so that you're not at the hands of one thing doing well, because we know that from the past couple of years, like oil and gas is really popular at times, or technology stocks, but it doesn't mean they're going to be popular or making money forever. So a good diversified range of things is better. But I think it's quieting the noise and not taking tips of somebody who's maybe not educated or qualified to give you those tips.
Yeah, I think that's really it, isn't it? I think the market bubbles and kind of the next big thing used to be tulips, if you go back long enough. And how ridiculous does that sound now? So I think your point on having something diverse there is really important. So even if you think this company or this asset class is absolutely what you believe will be successful, actually don't have all your eggs in that basket. Have it diversified across other things. I think that's a kind of a key message to get across.
One of the things I would say is if it sounds too good to be true, it quite often is as well. So just be really careful, because you could lose everything if it was the wrong thing.
And I like the idea of listening to the right person, because if we like someone, if it's someone we're familiar with, doesn't mean that they're an expert in that field.
Yeah.
And on that point, actually, now anybody with a webcam can portray themselves as an expert. So you've got to be really careful about what people's credentials are, and actually what is their purpose of giving you that message. So you need to know what is the source of the information you're getting.
Filtering that.
Yeah, good point. Okay, one question I seem to get asked a lot of is, I like investing in this asset or this share, I've got a holding in it, should I just keep doing the same thing? Is that something you're asked?
Yeah, I get asked that quite a lot as well. And the answer is no. A lot of the time when people have a particular shareholding, it's because it's the company they work for, or it's maybe they've inherited those shares. And if you think about it, the company you work for is actually really, really important to your financial security. So then having your investments invested in that company as well, you're just concentrating your risk unnecessarily. So no matter how well you think you know that company or what how good its prospects are, there's always the chance that there's been, in history, there's been plenty of examples of good profitable companies ceasing to be good profitable companies. You don't want to be overly exposed to it.
I think the problem with that is the ease of it, because it's so much easier to just take something you're given, if it's a company share, if it's an inheritance, and just do nothing, because you think, well, it's already there, it's kind of okay, isn't it? So I'll just keep it running. But it makes sense to just take a look at it and think, does it work for me? Is that the right thing? And readjust it if necessary. That's the right thing to do.
It's a good point. It's the comfort factor, isn't it? The better the devil you know. I think inheritance is a great example, because you see people inheriting share portfolios or asset classes, and it might not be anything they agree with socially responsibly, or it might be really risky and they're not particularly wanting to take risks. So it's looking at that and addressing it for your own needs, isn't it? And making it work for you. One
of the questions I often ask to people is, if you had that amount of money in cash, would you go out and buy that asset? And if the answer is no, then you shouldn't hold it just because you hold it. Yeah, there's quite a good example of market sentiment where it might not be the holding or the asset that's the problem, it's just the market sentiment is against that. The fashion of that thing is not in favour, isn't it? So the asset becomes undervalued. But it's definitely going back to your own goals and saying what works for me, and not have all your eggs in one basket.
Diversify. Just the one word, diversify.
Yeah, we keep coming back to that point, don't we, about diversification.
Yeah.
So to sum this up, what would be your top tip to help people manage their emotions when investing?
I would say stay calm, stay focused on the long term, and try and shut down the noise of the short term. Just keep to your goals. For me, no matter how confident you are that you're going to get something right or wrong, just be aware that that might not be correct. So stay diversified. Don't put all your eggs in one basket, and stay diverse.
For me, it would be if you're in the situation where you're panicking, if you're feeling stressed, if you're unsure what to do, just ask the expert, speak to someone. It will help you distance yourself from the noise and see the wood for the trees.